Yes, Britain is a nation of Eurosceptics. A survey of British national attitudes by NatSen revealed that nearly 3/4 of Brits either want to leave the European Union or think Britain should stay in the Union but reduce its powers. However, the poll also reveals that 60% of Brits would vote to remain in the EU, as they are not certain the UK economy would be better off out of the Union. Are they right? What would be the impact of a Brexit on investments? I have Greaves, Head of Research at FinnCap, on the line. Hello, Raymond.
Good morning, Charlotte.
Thank you for joining us. Now, this survey is very interesting because it shows that although people are mostly unhappy with the current EU membership arrangements, they're still not prepared to leave it yet. And it's mostly to do with their fears about the economic consequences of a Brexit. So I'd like to know what you think should be considered in the debate.
Yes, I think the survey that you talk about is a classic example of it's better the dog you know than the dog you don't. And I think we've been in the EU for so long now that there's obviously a considerable amount of certainty. What does it mean if we leave? And I think for me, there's obviously an awful lot of emotional factors that people consider with the EU, but I think the things that we should be most concerned about would be those that affect our sort of economic welfare. And I think the two things that come under that heading most obviously to me is the issue of immigration and the issue of trade. And very briefly on those two subjects, first of all on immigration, obviously a very hot topic again at the moment. But I think most people in the UK will be very surprised to hear that we've benefited immeasurably from immigration, particularly from the Eastern European states. And what this has meant is that we've had a very ready supply of labour that's prepared to come to this country. And contrary to popular opinion, they don't tend to sit around drawing benefits. They actually get on and work. And as a result of this, we can now get our cars washed very cheaply at the weekends. We have cleaners that are almost certainly from Eastern Europe. We have au pairs from Eastern Europe. And we have a ready supply of builders, plumbers and electricians that are well qualified and pleasant and actually get the job done efficiently. And that was not something that you could probably claim all the time 20 years ago. So, we've had a ready supply of relatively cheap and skilled labour into this country, which has been a big bonus. I think I read somewhere the other day that 1 in 5 new businesses started in the UK are opened by European immigrants. So we've had a lot of benefit to this economy from that. And the additional factor, of course, is it's helped keep inflation low. We've enjoyed very low inflation in this country for a long period of time. There's many factors and reasons for that, but one of them has been this supply of relatively cheap, skilled labour into the country because of free movement of labour in the EU. So I think there's been a very positive side to immigration, which people don't realise, and obviously that could dry up if we exit the EU, which could feed through to less skilled people being available and inflation rising, which could result in rising interest rates as well to control that. So I think that's one aspect people need to consider carefully. And the second one is that of trade. We are obviously the EU is our biggest trading partner, and we are theirs actually. But when you look at the details, we're actually run a very, very large trade deficit with the EU, which might lead you to believe that we're better out than in, because we're clearly not getting as much benefit from this relationship as the German car manufacturers and machine tool makers are, and the French cheese and wine and chemical makers and Italian luxury good manufacturers. They're clearly very much enjoying the benefits of our membership with the EU, and maybe we're not as much. But if we come out, what's the implication? What people forget is it's not just to do with our trade, the fact that we do this trade with the EU because it being a common market. There is also World Trade Organization rules out there which governs a lot of manufactured goods. So all these people that are making things and selling them into the UK will continue to have access into the UK under World Trade Organization rules. That will continue unfettered, as will our ability to sell manufactured goods into Europe. So that isn't much of a problem. The thing that I foresee as being a major problem for the UK is that one of our largest export areas, of course, is services. to do with banking and asset management and insurance, even architectural services, engineering consultancy, pharmaceutical research. All these things we are very good at in the UK. They're high-value industries and high-value jobs, and we run a large trade surplus with Europe on those sectors. These sectors are not covered by World Trade Organization rules. They might be at some point in the future, but they're not now. And so we run a large risk leaving the EU that we would have to renegotiate trade terms for those sectors into the European economy. And one can imagine that the EU, having lost the UK, might be quite reluctant to try and strike those trade deals. They'd obviously much rather have those high-value industries and jobs in their own country. So I think leaving the EU poses a very significant risk to those industries.
Okay. Now, Raymond, from an investment perspective, polls, as the last general election proved, are not always that accurate at predicting results, as we know. So if Britain votes for a Brexit, what reactions are we likely to see across financial markets?
Well, I think history suggests with these things, no matter how much people anticipated or think about it, the shock of it actually happening will make people very worried for a period of time. So the natural reaction to that will be a sell-off in sterling, a sell-off in government gilts, and a sell-off in equities. So the first days and weeks after that event are likely to be a little bit tumultuous, I suspect. What happens beyond that? What's the sort of more rational response? Well, I think it is correct to say that sterling will be weaker. I mean, it's already weakened quite a lot this year. And that obviously will be a significant benefit for many small businesses, particularly those that are exporting into different countries around the world. So the smaller manufacturing businesses that are trying to grow their businesses into Europe and the rest of the world would be a significant beneficiary, actually, of a weaker pound. There's no doubt about that. We sort of get a one-off sort of productivity gain from a weaker pound. So we don't have an awful lot to fear from that perspective, I don't think. But as I sort of mentioned earlier, the industries that are going to potentially suffer, and see this will be the biggest shock reaction, I suspect, will be those service industries that won't have automatic access back into European markets under World Trade Organization rules, and will potentially find access to the common market that much more difficult. So that's the area where I see the biggest probably investment risk. The slightly more Armageddon scenario is that obviously if you start seeing a lot of these high-value jobs being transferred back into Europe, you'll see a lot of well-paid Europeans moving out of the UK and specifically London back into Europe, which could obviously destabilize the commercial and residential property markets in London and possibly in the wider southeast region.
And Raymond, what about the impact on small and mid-cap shares? Because a lot of these companies are actually quite exposed to the UK economy and the EU economy.
Yes, I mean, again, as we've discussed before, I'm an enthusiast of smaller companies because they tend to be more master their own destinies in terms of through innovative business models or strong IP or something like that. They can actually generate growth even in the most tricky environments, whether it's tough economic growth or even something like a Brexit scenario. So I think I'd be a bit more bullish about smaller companies. As I mentioned earlier, the pound is likely to be weaker, which a lot of these smaller companies, if they're making something or exporting something to Europe, they're going to get the benefit from a weaker pound. And certainly for traded goods, they'll be covered under World Trade Organization rules anyway, so they should be able to pretty much carry on as before. So I think the smaller goods-orientated businesses haven't got an awful lot to fear from a Brexit type of scenario. It would be the financial service companies in the smaller cap arena that I would be more worried about because, as I mentioned earlier, they wouldn't necessarily have automatic access to European markets because it's not covered under WTO, and they'd be reliant on the British government setting up those trade agreements in time. So I think that's the area where there's the bigger risk. There's clearly the risk on the property side as well, as we mentioned earlier, on the private and commercial real estate if we do see significant job losses and a lot of these high-value industries and jobs move back into Europe. But let's not also forget that there's at least a 2-year transition period from a Brexit as everything gets worked out and unpicked. So the immediate short-term actual trade impact probably won't be very big. It will only become more apparent over time.
Okay, Raymond, thank you very much.
You're welcome. Thank you, Charlotte.
Raymond Greaves, Head of Research at FinnCap.